Hello and welcome to SRA Accounts Rules Compliance. This is Part 3, a look at common breaches of the SRA Accounts Rules. If you've not yet seen Part 2, this covered reportable breaches. My name's Jenny Staight and I'm joined by my colleague Faye. Our contact details are on the screen, so if you'd like to contact us about anything in this webinar or related topics, please do so.
Let's start with a recap on materiality. In order to determine if something is material, the SRA suggests you consider the detriment or risk of detriment to clients, the extent of any risk of loss of confidence in the practice or in the provision of legal services, the scale of the issue, the overall impact of the practice, its clients and third parties. You should also note that whilst a single breach may be trivial, if it's a part of a series of breaches, it may be material. To decide whether something is material, our guidance is that you should consider whether the breach was an innocent mistake, whether the breach was an isolated instance, whether it was discovered promptly and corrected, and whether the error was for a trivial amount. If the answer to all of these questions is yes, and provided there's no loss to any client, we would normally class this as trivial. A simple way to think about it, when you identify a breach, if you say, oops, it's likely to be trivial. If you say, oh no, it's likely to be more serious. Last year, Hazlewoods completed 88 accountants reports. From these reports, we collated the top 10 breaches. So, number 1 was Rule 29.9, current balance on client ledgers. 2. Rule 29.4, current balance on office ledgers. 3. 14.3, returning balances to clients promptly upon the completion of a matter, or residual client balances. 4. 14.1, which is client money being paid promptly into the client account, or office ledger credit balances. 5. Rule 29.1, keeping accounting records properly written up. 6. 20.1, withdrawals from the client account. 7. Rule 17.3, transfer of funds earmarked for cost. 8. 29.2, miscellaneous ledgers. 9. Rule 29.25, incorrect use of a suspense account. And 10. Rule 29.12, covering reconciliations. Okay, so if we take each of these in turn, the breach we saw the most was Rule 29.9, so current balance on client ledgers. The current balance on each client ledger account must always be shown or be readily ascertainable from that was kept. Any misposting of a client transaction can result in a breach. If the error is corrected immediately, it's not a serious issue, provided it does not happen too often, and it often occurs as a result of mistakes made when completing authorization slips. So, in order to make sure we don't breach this rule, we should avoid sundry and miscellaneous ledgers, avoid backdating transactions, and make sure that we have separate ledgers for all clients. Fee earners need to remember to comply. A suggested control is that fee earners regularly review client ledgers to make sure that they're up to date and all the transactions that they expect to see are there.
Rule 29.4. All dealings with office money relating to any client matter or to any trust matter must be appropriately recorded in an office cash account and on the office side of the appropriate client ledger account. This is the same principle as 29.9, but you have to remember that office ledgers matter too. Make sure correct ledger references are used when completing slips. Our suggested control here is that you, as well as regularly reviewing client ledgers, make sure you review the office side as well.
The third most commonly noted breach was in relation to Rule 14.3, residual client balances. The rule states that client money must be returned to the client, person on whose behalf the money is held, promptly, as soon as there is no longer any proper reason to retain those funds. Payments received after you have already accounted to the client, for example by way of a refund, must be paid to the client promptly too. Remember, as mentioned in our last webinar, this was the breach we reported to the SRA the most last year. In order to comply with Rule 14.3, you should ensure that clients' funds are returned promptly to clients upon completion of matters. The rules do not define promptly. This requires your judgment. When we note breaches of the rule, it's often in relation to small amounts, and the breach often occurs as a result of cheque payments expiring and not being reissued. You should also bear in mind that there is no longer a distinction between pre- and post-2008 balances. Whilst this was included in the 1998 rules, it was not included in the 2011 rules. So, the practice is required to make reasonable attempts to establish the identity of the owner, ascertain the proper destination of the money, and return it to the rightful owner. They should not sweep up the money under any circumstances, unless the cost of doing so is excessive. Please note that the costs do not include fee earner or staff time. If you incur costs such as tracing agents' fees, etc., you must get permission from the SRA before you do this from the client balances.
Only if all of these criteria are met can you donate the money to charity. Amounts under £500 require no prior authorisation from the SRA. Amounts over £500, you will need to get prior authorisation from the SRA and possibly a supporting letter from your accountants. To be able to donate the funds to charity, the charity must be registered and it should offer you an indemnity. In all cases, you must keep a record of the steps taken to return the funds. Our suggested control for Rule 14.3 is that you run a list of client balances on a regular basis with the date of the last movement where possible, and you review for old balances where there has been no movement.
Okay, so the next rule is 14.1, Office Ledger Credit Balances. The rules state, client money must without delay be paid into a client account and must be held in a client account except when the rules provide to the contrary. You should note that this rule does not just cover the prompt banking of client receipts, it also covers instances where client money is not paid into a client account resulting in office ledger credit balances. The main causes of office ledger credit balances are credit notes, refunds received, clients paying funds into the office account by mistake, and client-to-office transfers being performed in excess of funds due on office. A suggested control here would be to run a report on a daily basis to identify any office ledger credit balances. Most systems do have a standard report for this, but if not, a full listing of office balances should be reviewed.
Next, we have Rule 29.1, keeping accounting records properly written up. The rules state you must at all times keep accounting records properly written up to show your dealings with client money received, held, or paid by you, including client money held outside a client account under Rule 15.1a or 16.1d, and B, any office money relating to any client or trust matter. Transactions must be posted to both client and office ledgers promptly, and this also helps with Rule 29.4 and 29.9. Breaches of this rule indicate systemic issues rather than one-off admin errors, and COFA may need to consider reporting any breaches of this rule to the SRA. Our suggested control is that you reconcile the client and office bank accounts on a daily basis to ensure all receipts and payments are posted to client and office ledgers promptly.
Okay, so the sixth most common breach that we noted was of Rule 20.1, which relates to withdrawals from client account. The rules state that withdrawals from client account must only be made when properly required for payment to or on behalf of the client, where they are required for the payment of a disbursement on behalf of the client, where they are required to reimburse the practice for money spent on behalf of the client, where they are transferred to another client account, withdrawn on client's written instructions, or to remedy a breach, for example, paid into the wrong deposit account. The main problems noted relate to monies transferred for unpaid disbursements resulting in office ledger credit balances. Before making withdrawals, you must ensure you're entitled to the full amount before making a transfer from client account. You must make sure the funds are not earmarked for other purposes. You must make sure you give the accounts team the correct instructions, and you should review the client ledger before making any withdrawal. The client account must not be overdrawn under any circumstances. Individual client ledgers normally should not be overdrawn unless sufficient money is held on a separate matter for the same client to cover the balance, or sufficient money is held on a deposit account for the same client to cover the balance. A suggested control for this rule is that all withdrawals must be approved by an appropriate person prior to being actioned, and they should sign the documents as evidence of this. This also ensures you're complying with the guidelines.
Rule 17.3 covers the transfer of funds earmarked for costs. Rule 17.2 states, if you properly require payment of your fees from money held for a client or trust in a client account, you must first give or send a bill of costs or other written notification of the costs incurred to the client or the paying party. Provided that this is adhered to, once the bill is raised, money on the client account becomes earmarked. The solicitor earmarks the funds, not the client. This includes partial funds, however small. Earmarked funds must be transferred to the off account within 14 days, what's commonly known as the 14-day rule. Remember that with conveyancing matters, the 14 days starts from the date of completion and not the date of the bill. For probate matters, some assume the 14 days start when the executor approves the payment. This isn't the case. 14 days start when the bill is raised. If in doubt, use a pro forma bill. Our suggested control here is that you run a report regularly showing all matters of client funds available and balances outstanding on the office account. Review the report for instances where funds need to be transferred from the client to the office account.
The next breach is in relation to Rule 29.2, so the use of miscellaneous ledgers for multiple clients. The rules require all dealings with client money to be appropriately recorded in a client cash account or in a record of sums transferred from one ledger account to another, and on the client side of a separate client ledger account for each client or other person or trust. No other entries may be made in these records. Okay, so a separate ledger must be set up for every client. Miscellaneous ledgers can be confusing if used for multiple clients. This also helps to ensure compliance with Rules 29.4 and 29.9, so current balance on client and current balance on office. A suggested control here is to avoid the use of suspense accounts at all. Ensure fee earners do not commence work until due diligence on client is complete and the matter is opened. You should not receive money from clients until you have completed your money laundering procedures.
If you remember from Part 2, the second highest number of reportable breaches related to Rule 29.25, incorrect use of the suspense account. The rules state that suspense client ledger accounts may be used only when you can justify their use, for instance, for temporary use on receipt of an unidentified payment, if time is needed to establish the nature of the payment or the identity of the client. Suspense accounts are allowed, but only on a temporary basis. Ensure limited use of suspense ledgers. Ensure the use is justified for all balances and not just a dumping ground for old amounts. Too many indicates control weaknesses. Frequently arise on system changeovers. Regular reviews are necessary. If you have a lot of suspense accounts, you're at risk of missing any internal fraud, and it's the responsibility of fee earners to review the balances too. Our suggested control is that if a suspense account is used, you must review and reconcile this on a regular basis. Do not hold receipts on a suspense account for long periods of time. If you can't identify the owner, return them.
The final rule in our top 10 is Rule 29.12, so reconciliations. The rules state that you must, at least once every 5 weeks, compare the balance on the client cash accounts with the balances shown on the statements and passbooks, after allowing for unpresented items of all general client accounts and separate designated client accounts, and of any account which is not a client account, but in which you hold client money under Rule 15.1a or Rule 16.1d, and any client money held by you in cash. And As at the same date, you should prepare a listing of all the balances shown by the client ledger accounts of the liabilities to clients and other persons and trusts, and compare the total of those balances with the balance on the client cash account, and also prepare a reconciliation statement. This statement must show the cause of any difference, if any, shown by each of the above comparisons. So, client reconciliations are probably one of the best places to spot frauds. Things you should watch out for include journal entries, adjusting items, unusual or missing narratives, long-standing items suddenly clearing, and unclear transfers, TPs, or receipts. A suggested control with client account reconciliations is that they should be reviewed by the COFA or an appropriate person, and we recommend that the reconciliations are signed as evidence of this review. This also ensures you are complying with the guidelines.
Thank you for listening. The next instalment in this series of webinars will cover the role of the COFA. Our contact details are on screen, so please get in touch if you have any questions at all.